You think investing is about picking the right stocks, but what if I told you the real wealth killer isn't bad picks? It's your inconsistency. In the next few minutes, I'm going to walk you through the systematic principles of disciplined wealth creation that compound over time. And if you stay with me until the end, you'll discover how to build unshakable investment habits that work regardless of market conditions. So, before we dive in, do me a favor, hit that like button, subscribe if you haven't already, and tell me in the comments where you're watching from. Because your financial transformation starts the moment you commit to consistent, rational action. Here's what most investors get wrong about building wealth. Listen, I've spent decades studying markets, human behavior, and the fundamental principles that separate those who build lasting wealth from those who chase every shiny opportunity that comes along. And here's what I've learned. What I want to burn into your consciousness right now, the difference between financial success and failure has almost nothing to do with how much money you start with. Nothing. It has everything to do with the consistency of your approach, the discipline of your execution, and your willingness to let time and compounding work their magic while everyone else is panicking or celebrating. You want to know what keeps me up at night? It's not market crashes. It's not inflation, though. That's certainly a thief we must guard against. What troubles me most is watching intelligent people sabotage their own financial futures through inconsistency. They invest $1,000 one month, nothing for 3 months, then pull everything out when the market dips 10. They read about a hot stock and abandon their strategy. They let fear drive them out of the market at the bottom and greed pull them in at the top. And then, and this is the tragedy, they blame the market, the economy, the system, when the real problem was staring at them in the mirror the entire time. Let me ask you something painful, something real. Have you ever started an investment plan with absolute conviction, only to abandon it the moment things got uncomfortable? Have you watched your account balance fluctuate and felt that pit in your stomach that made you want to sell everything and hide under your mattress? Of course you have. We all have. Because you're human. And humans are wired to react to immediate threats and immediate rewards. But here's the brutal truth. Those instincts that kept our ancestors alive on the savannah are the same instincts that destroy wealth in modern markets. Your biology is working against your prosperity. Now, if I had $10,000 to invest today, not in some theoretical future, but right now in 2026, I wouldn't be looking for the next big thing. I wouldn't be chasing cryptocurrency dreams or trying to time the market perfectly. Instead, I'd build a system so robust, so grounded in economic reality, that it would work whether the market goes up, down, or sideways. And that system would have one non-negotiable foundation: consistency. Because let me tell you something that Wall Street doesn't want you to know. They profit from your inconsistency. Every time you panic and sell, every time you chase the hot stock, every time you abandon your plan, someone else is making money from your emotional decision-making. Here's what I do differently and why it matters. I divide that $10,000 into a systematic allocation that forces consistency through structure itself. 60%, that's $6,000, would go into broad market index funds. Not because they're exciting, they're not, but because they represent ownership in the productive capacity of the economy itself. When you own a piece of every major company through an index fund, you're not betting on individual winners. You're betting on human ingenuity, innovation, and the fundamental drive for progress that has powered economic growth for centuries. And that, my friend, is a bet that has historically paid off for patient, consistent investors. But here's where most people stop thinking. They put all their money in one place and call it diversification. That's not diversification. That's just owning a lot of one thing. So another 20%, $2,000, goes into real assets that protect against the silent wealth destroyer we call inflation. I'm talking about Treasury inflation-protected securities, real estate investment trusts, or commodity-based funds. These aren't get-rich-quick vehicles. They're insurance policies that ensure the purchasing power of your wealth isn't eroded by monetary expansion. Because what good is a 7% return if inflation steals 8% of your purchasing power? The final 20%, $2,000, is your learning allocation. This is money you invest in individual opportunities where you develop judgment, test theories, and yes, sometimes fail. But here's the critical distinction. You're not gambling with your entire future. You're learning with a controlled portion, while the bulk of your wealth follows proven principles. This is how you develop the investor psychology necessary for long-term success without risking everything on your education. Now pay attention to what I'm about to tell you, because this is where consistency transforms from a nice idea into a wealth-building machine, the compounding power of systematic action that everyone ignores. You've heard about compound interest, right? Einstein supposedly called it the eighth wonder of the world, though I doubt he actually said that. But here's what most people miss about compounding. It's not just about returns on returns. It's about consistent behavior on consistent behavior, creating exponential growth in your financial discipline itself. The person who invests $500 every single month without fail, regardless of market conditions, isn't just building an account balance. They're building an identity as a consistent investor. And that identity becomes self-reinforcing in ways that dwarf any individual investment return. Let me show you something that will change how you think about investing forever. Imagine two investors. Let's call them Sarah and Tom. Sarah invests $10,000 once and never adds another dollar. Tom invests $10,000 initially, but adds just $200 every single month after that, $2,400 per year. Over 20 years, assuming a 7% average annual return, Sarah's investment grows to about $38,697. Not bad, but Tom's account, it grows to over $140,000. The additional contributions only account for $48,000 of that difference. The rest, nearly $100,000, is the pure magic of consistent action meeting compound growth. But here's what nobody tells you about that mathematical reality. The hardest part isn't the math, it's the psychology. Because there will be months, maybe even years, when adding that $200 feels pointless. The market will be down 15%, and your account balance will look worse than it did 6 months ago, and you'll think, why am I throwing good money after bad? And that right there is the moment that separates wealthy investors from everyone else, because the investor who keeps contributing during the decline is buying assets at discount prices. They're accumulating more shares for the same dollar amount. When the market recovers, and it always has, those pointless contributions become the most profitable investments they ever made. Have you ever stopped contributing to your investment accounts because the balance wasn't growing fast enough? Have you ever thought, I'll start investing again when the market stabilizes? Listen to me carefully. That thinking has cost you more money than any market crash ever could, because what you're really doing is trying to time the market. And timing the market is a loser's game that even professionals fail at consistently. The data is overwhelming on this point. Study after study shows that missing just the 10 best days in the market over a 20-year period can cut your returns in half. But those best days often come right after the worst days, when fear is highest and consistency feels most difficult. So how do we force ourselves to be consistent when every fiber of our being wants to react emotionally? We remove emotion from the equation entirely. This is where systematic automation becomes your greatest weapon against your own psychology. Set up automatic transfers from your checking account to your investment account on the same day every month, preferably right after you get paid, before you can spend that money on something else. Make it impossible to forget or decide later, because every decision point is an opportunity for your emotions to sabotage your future. Automation eliminates decision points. But let me address something that's probably bothering you right now. Milton, what if I can't afford $200 every month? What if I have debt? What if unexpected expenses come up? Fair questions. And here's the honest answer. You start with what you can genuinely sustain. If it's $50 a month, fine. The amount matters far less than the consistency, because what you're really building isn't just wealth. You're building the neural pathways of disciplined financial behavior. You're training yourself to prioritize future prosperity over present consumption. and that training compounds just like investment returns do. Think about it this way. Would you rather invest $500 sporadically when you have extra money, or $100 consistently every single month? The consistent approach wins every time, not just financially, but psychologically. Because inconsistent investors develop an adversarial relationship with investing. It becomes something they should do, but often don't, creating guilt and anxiety. Consistent investors develop an identity around their behavior. They become someone who invests every month no matter what. And that identity shift is worth more than any hot stock tip. Now here's something that will blow your mind, the principle of consistency applies not just to contributions, but to your entire investment philosophy. Why your investment strategy must weather every storm. I've seen it happen 1,000 times. An investor carefully researches their strategy, allocates their money thoughtfully, and then the market drops 20%. Suddenly they're reading articles about a coming recession, listening to predictions of doom, and that carefully considered strategy goes right out the window. They sell at the bottom, sit in cash while the market recovers, then buy back in near the top. Congratulations, you just lost money following your emotions instead of your strategy. Here's what you need to understand. At a bone-deep level, market volatility isn't a bug in the system, it's a feature. It's the price we pay for the long-term returns that equity markets provide. If investing was easy and comfortable all the time, everyone would do it, and the returns would evaporate. The discomfort you feel during market declines is actually the source of your future profits, because those who can sit through that discomfort and maintain their strategy are essentially being paid a premium for their discipline. Let me say that again. You are compensated for being consistent when others panic. But I'm not going to pretend this is easy. I'm not going to tell you that watching your account balance drop 30% in a matter of weeks won't make your stomach churn. Of course it will. You're human. But this is where having a strategy based on fundamental economic principles becomes your psychological anchor. When the market crashes, I don't ask myself, should I sell? I ask myself, have the fundamental productive capacities of the global economy disappeared? And the answer is always no. Companies still produce goods and services. Innovation still continues. Human ingenuity still solves problems. The market price is just a temporary disagreement about value. It's not a permanent destruction of economic reality. Let me share something from my own experience that illustrates this principle. During major market downturns, and I've lived through several in my career, I watched brilliant colleagues abandon sound strategies out of fear. They sold during the 1973 to 74 recession when the S&P 500 dropped 48%. They panicked during the 1987 crash when the market fell 23% in a single day. And in every single case, those who maintained their consistent investment approach, who kept buying systematically through the decline, ended up dramatically wealthier than those who tried to protect themselves by selling. Now, let me ask you something that might sting a little. What's your actual investment strategy? Not what you think it should be, but what you actually do with your money. Can you articulate it in 3 clear sentences? Because if you can't clearly state your strategy, you don't really have one. You have a collection of impulses and reactions that feel like strategy, and without a clear strategy, consistency is impossible because you have nothing consistent to follow. Here's what a real investment strategy looks like for that $10,000 we're discussing. I allocate 60% to broad market index funds, 20% to inflation-protected assets, and 20% to individual learning opportunities. I contribute an additional fixed amount on the first of every month, regardless of market conditions. I rebalance once per year to maintain my target allocations, and I do not sell in response to market declines unless my fundamental life circumstances change dramatically. That's it. Simple, clear, and executable. The complexity isn't in the strategy, it's in maintaining the discipline to follow it consistently. But here's where it gets really interesting and where most investment advice completely misses the point. Your strategy must be simple enough that you can follow it consistently, but robust enough that it works across different economic environments. Because the worst thing that can happen isn't a market crash. It's discovering that your strategy only works in one type of market condition. That's why I emphasize diversification across asset classes and systematic contributions through all market conditions. These principles aren't just good theory. They're survival mechanisms that keep your wealth building on track when others are derailing. And let me tell you what nobody wants to hear. The psychological difficulty of maintaining consistency actually increases with your account balance. When you have $5,000 invested and the market drops 20%, you've lost $1,000. That stings, but it's bearable. When you have $500,000 invested and the market drops 20%, you've lost $100,000. That's more than many people make in a year. The temptation to protect what you have by selling becomes almost overwhelming. This is why building the consistency habit when the numbers are smaller is so critical. You are developing the psychological immunity you'll need later when the stakes are higher. Now here's the principle that ties all of this together and makes consistency not just possible but inevitable, creating an environment where failure becomes impossible. You know what I've discovered after decades of studying human behavior and economic systems? Willpower is overrated. People think successful investors have some superhuman discipline that allows them to resist temptation and stick to their plans. But that's not what I've observed at all. The most successful investors I know aren't the ones with the most willpower. They're the ones who've structured their environment so that consistency is the path of least resistance. They've made good decisions automatic and bad decisions difficult. Think about how this applies to our $10,000 investment strategy. Instead of relying on your memory and discipline to contribute every month, what if you couldn't not contribute? What if the money was automatically transferred from your paycheck before it ever hit your checking account? Suddenly, you're not making a decision to invest. You're making a decision to stop investing, which requires active effort. That's environmental design at work. You've flipped the script so the consistency is the default behavior. But this goes deeper than just automatic transfers. Let me ask you, where do you keep the login information for your investment accounts? Is it easily accessible so you can check your balance 10 times a day and make emotional decisions? Or is it deliberately inconvenient so that you have to really want to access it before you can? I'm going to tell you something controversial. Checking your investment accounts too frequently is actively harmful to your wealth. Studies show that investors who check their portfolios daily are more likely to sell during downturns because they're constantly exposed to the emotional impact of volatility. The investor who checks quarterly or even annually, they miss all that emotional turbulence and stay the course. Here's what this means practically. I'd recommend checking your investment accounts no more than once per quarter, and only then to rebalance if needed. Otherwise, your job is to keep contributing consistently and let time do the heavy lifting. But our modern world is designed to make this difficult. You get notifications about market movements. News outlets profit from creating panic about every economic indicator. Social media is full of people bragging about their investment gains, but rarely admitting their losses. All of this creates an environment that rewards emotional reaction and punishes patient consistency. So how do we counteract this? We deliberately create barriers between ourselves and emotional decision-making. Turn off notifications from financial apps. Unsubscribe from investment newsletters that create panic. Set a rule that you won't make any changes to your investment strategy without sleeping on it for 72 hours. This simple cooling off period will prevent 90% of emotional decisions, because the goal isn't to never feel the urge to panic. The goal is to prevent panic from turning into destructive action. But let me address something. You might be thinking, Milton, doesn't this mean I'm being inflexible? What if circumstances genuinely change and I need to adjust? Excellent question. And here's the distinction. Your strategy should adapt to fundamental changes in your life circumstances. Getting married, having children, approaching retirement, not to changes in market conditions. Your life stage determines your risk tolerance and time horizon. Market movements don't change those fundamental factors, so they shouldn't change your strategy. Think about it this way. If you're 30 years old with 35 years until retirement, does it really matter if the market is down 20 today? Not fundamentally. Your time horizon hasn't changed. Your capacity to recover hasn't changed. What's changed is a temporary price, nothing more. But if you're 64 years old planning to retire next year, that same 20% decline might genuinely require a strategic adjustment because your life circumstances make recovery time limited. See the difference? One is responding to noise, the other is responding to signal. Here's something I learned from watching thousands of investors over my career. The people who get wealthy aren't the smartest or the ones with the best information. They're the ones who can maintain boring consistency while everyone else is chasing excitement. Wall Street doesn't want you to know this because boring consistency doesn't generate trading fees, but the data is undeniable. Investors who trade frequently underperform those who buy and hold by an average of 3 to 4% annually over a lifetime. That difference is literally millions of dollars transferred from impatient investors to patient ones. Now let me show you how to implement this environmental design with our $10,000, the complete system that forces you to win. All right, let's get specific about exactly how you'd implement this. Strategy, starting today, not tomorrow, not next week, but today, because the gap between knowing what to do and actually doing it is where most financial dreams go to die. We're going to close that gap right now by creating a system so complete, so foolproof, that your success becomes inevitable if you simply follow it. First, that $10,000 gets allocated immediately, today, not when the market seems right or after I do more research. Today, 60%, $6,000, goes into a broad market index fund, something like a total U.S. stock market fund or a global equity fund. I don't care which specific fund you choose, as long as it has low fees under 0.20% expense ratio and represents broad exposure to productive companies. Why the urgency? Because every day you delay is a day you're not in the market, and we've already established that timing the market is impossible. You're better off being in the market with a decent strategy than sitting on cash waiting for the perfect moment. 20%, $2,000 goes into inflation-protected assets. I'd split this between Treasury inflation-protected securities and a real estate investment trust fund. These aren't exciting. They won't make you rich overnight, but they serve a critical function. They protect your purchasing power when monetary expansion erodes the value of regular currency. This is your insurance policy against inflation, the silent thief that has destroyed more wealth throughout history than any stock market crash. The final 20%, $2,000, is your education allocation, money you invest in individual stocks, bonds, or opportunities where you're actively learning about valuation, risk, and market psychology. But here's the rule. This money gets deployed thoughtfully, one investment at a time, with clear reasoning documented before you make each purchase. Why? Because you're not gambling. You're developing investor judgment. And judgment develops through deliberate practice with real stakes, not through paper trading or theory. Now here's where the consistency mechanism kicks in. You set up an automatic monthly contribution the day you make your initial investment. Whatever amount you can genuinely sustain, $100, $200, $500, gets automatically transferred from your checking account to your investment account on the same day every month. Let's say it's $200. That money gets allocated using the same percentages. $120 to index funds, $40 to inflation-protected assets, $40 to your learning allocation. This happens every single month, whether the market is up, down, or sideways. But we're not done with the system yet, because consistency isn't just about contributions. It's about maintaining strategy discipline through market chaos. So here's your next rule. You check your account balance and performance exactly 4 times per year, once per quarter, and you do it on the same day each time. Maybe it's the first Saturday of January, April, July, and October. During these quarterly reviews, you assess whether your allocations have drifted from your targets due to market movements. If your stock allocation has grown to 70% because of strong market performance, you rebalance by selling some stocks and buying more of your underweighted positions. This is critical. Rebalancing forces you to buy low and sell high systematically, selling assets that have become expensive and buying assets that have become cheap outside of these quarterly reviews. You don't check your accounts. You don't read the financial news daily. You don't watch market commentators predicting doom or euphoria. Why? Because all of that is noise designed to make you feel like you need to do something. The financial media profits from your engagement, not your success. They need you panicking when the market drops and excited when it rises because that drives viewership. But you profit from ignoring all of that noise and maintaining your system. Now, let me anticipate your question. Milton, what if I need the money? What if an emergency comes up? This is why you have an emergency fund separate from your investment accounts. Before you invest $1, you should have 3 to 6 months of living expenses in a high-yield savings account for true emergencies. Your investment accounts are not your emergency fund. They're your long-term wealth-building system. Mixing these two purposes is how people get forced to sell investments at the worst possible time. Separate purposes require separate accounts. Here's something critical that most people miss. The system I'm describing doesn't guarantee you'll pick winning investments every time. You won't. Some of your individual stock picks will fail. The market will have years where it declines. But the system guarantees that you'll be in position to capture the long-term growth of productive assets, that you'll buy more when prices are low through consistent contributions, and that you'll avoid the emotional mistakes that destroy wealth. That's not a guarantee of specific returns. It's a guarantee that you're playing the game correctly. Let me share why this matters so much to me personally. I've spent my career advocating for free markets and voluntary exchange because I believe these systems create prosperity better than any alternative. But markets only create prosperity for participants. If you're not consistently investing in productive assets, if you're hiding under your mattress or making emotional decisions, you're not participating, you're spectating. And spectators don't build wealth. This system, this boring, consistent, automated system, is how you become a participant in the prosperity-generating machine of market capitalism. Think about where you'll be 5 years from now if you implement this system today. Let's be conservative and assume a 7% average annual return, below the historical stock market average. Your initial $10,000 plus $200 monthly contributions becomes approximately $24,000. But here's what's even more important. You've made 60 consistent monthly contributions through various market conditions. You've rebalanced 20 times, forcing yourself to buy low and sell high. You've developed an identity as someone who invests consistently regardless of circumstances. That identity and those habits are worth more than the $14,000 growth in your account. They are the foundation of a lifetime of wealth building. But let me tell you what happens if you don't implement a system. If you keep planning to invest without actually doing it. 5 years from now, that $10,000 sits in your checking account, having lost approximately 15 to 20% of its purchasing power to inflation. You're $10,000 poorer in real terms. Plus, you've missed out on the $14,000 in growth. Plus, you haven't developed any of the habits and identity of a consistent investor. The gap between these two futures isn't $14,000. It's the trajectory of your entire financial life. Now, in these final moments together, let me give you the truth that will determine your financial future. The choice that will haunt or liberate you forever. We've covered a lot of ground together, and I want to make sure you understand what's really at stake here. This isn't just about $10,000 or investment returns or even financial security. Though all of those things matter, this is about who you become through the choices you make consistently over time. Because here's what I've learned watching thousands of people navigate their financial lives. The person who can be consistent with money can be consistent with anything. Health, relationships, career, personal growth, all of these domains reward consistency over intensity. You know what terrifies me? It's not market crashes or economic recessions. Those are temporary. What terrifies me is watching people sabotage their own potential through inconsistency, then spending the rest of their lives wondering what could have been. I've met 65-year-olds who started investing late and said, I wish I'd started when I was 25. I've never met a 65-year-old who said, I regret investing consistently throughout my life. Think about that. The regret is always about inconsistency, never about consistency. So let me ask you directly, with all the passion and urgency I can muster, what are you going to do today, right now, this moment, to implement this system? Not tomorrow, not when you have more time to think about it, not after you do a little more research. Today, because the investment you make in your own discipline is the only investment with a guaranteed return. Every day you delay is a day you're choosing inconsistency over consistency, reaction over system, hope over structure. Here's your action plan, laid out so simply that there's no excuse not to implement it immediately. Step 1, open that investment account today if you don't already have one. Low-cost brokerages like Vanguard, Fidelity, or Schwab make this process take less than 15 minutes. Step 2, transfer that $10,000 and allocate it. According to the percentages we discussed, 60% broad market index fund, 20% inflation-protected assets, 20% learning allocation. Step 3, set up automatic monthly contributions for whatever amount you can sustain using the same allocation percentages. Step 4, calendar your quarterly review dates right now for the next year. Step 5, close this browser tab and don't check your account again until that first quarterly review. That's it. 5 steps between you and a wealth-building system that works regardless of your intelligence, your income level, or your ability to predict the future. But here's what I know about human nature. Most people watching this right now won't implement any of it. They'll nod along, they'll think that makes sense, they'll fully intend to do it, and then they'll get distracted by the next thing and never actually take action. And 5 years from now, they'll watch another video about investing, nod along again, and still take no action. Don't be that. The difference between people who build wealth and people who stay broke isn't intelligence, it's action. Specifically, it's consistent action over time. You don't need to be smarter, you need to be more disciplined. You don't need perfect information, you need a system you can follow imperfectly but consistently. Because an imperfect system followed consistently will outperform a perfect system followed inconsistently every single time. Let me leave you with this final thought. I've dedicated my life to understanding how markets work, how economies function, and how individual choices aggregate into societal outcomes. And here's what all that study has taught me. Your financial future isn't determined by government policy or economic conditions or even luck, though all of those things matter at the margins. Your financial future is determined by the daily choices you make consistently over decades. That's it. That's the secret. Boring, unglamorous, consistent decisions compounded over time. The person who invests $200 every month for 40 years will accumulate far more wealth than the person who tries to time the market, chase hot stocks, and make sporadic investments. The mathematics are undeniable. The historical data is overwhelming. The only question is, will you be the consistent investor or the sporadic one? Will you build a system or rely on willpower? Will you take action today or continue planning indefinitely? I believe in you. I believe in your capacity to implement this system and transform your financial life. But my belief doesn't matter. Your action does. So here's what I want you to do right now. Pause this video. Go implement step 1 of the action plan I just gave you, and then come back and leave a comment telling me you did it. Hold yourself accountable publicly. Tell me where you're watching from and that you're committing to consistent investment starting today, because that public commitment makes it real in a way that private intention never does. Your future self is watching you right now, hoping you'll make the choice that leads to financial freedom instead of financial regret. Don't let them down. The market doesn't care about your excuses, your fears, or your intentions. It only rewards consistent participation over time. So participate. Start today. Build that system. Force yourself to be consistent through environmental design and automation. And watch as the mathematical certainty of compound growth transforms your financial reality. Remember, the best time to start was 20 years ago. The second best time is right now, today, this very moment. You've got this. Now go make it happen. I'll see you at the top, where all the consistent investors meet.